Okay, good morning, everybody. Welcome to Ash Grove Learning and our webinar titled Compilation Engagements for Practitioners. My name is Penny Fair, and I've been involved with CPA Canada in the design of the compilation engagement standard when I was part of the task force, as well as I've been assisting with some of the updates. So the 2024 release of the PAT compilation checklists and the videos that are there now, I was also a little bit involved with. So hopefully my qualifications speak for themselves with respect to the compilation engagement, and hopefully my point of view based on my understanding will help you with the compilation engagement. The compilation engagement has standard CSRE 4200. I came into effect on December 15th of 2021. And now that it's had some time to run, it's becoming clear that there are areas where practitioners are having trouble or struggling. So this webinar, I designed it with the practitioner in mind, and we're going to cover the compilation engagement, focusing on areas where trouble seems to be arising. And if you're new to the compilation engagement standard, we do also have some other online courses. So you might find that you want a little bit more, and we've got two other courses online to help you with the compilation engagement as well, because we're not necessarily going to cover everything from A to Z here, but we are going to cover the important things. So hopefully that'll help you. As far as some administrative things go, we are probably going to run about 3 hours with this webinar. It goes a little higher or a little lower depending on questions, quizzes, and that kind of stuff. But that's about what I expect the time to be. We will give you a break in the middle. So you'll have a 10-minute break in the middle just to refill your coffee cups and anything else that needs to be doing. And in addition to that, we are recording this webinar. So if you have to leave to deal with some business or anything like that, and if you miss a part of it, this webinar will be available online for you. Now, to be able to access that, what you'll need to do is sign back into the website and log into your account. Look for this event on your account page, and the webinar will be uploaded there. Usually I can do it right away, but give me 24 hours just in case we have problems with the download. And at the same time, if you're looking for your certificates, that's where you'll find them as well, the same place. So with that going, we're going to turn off the video and we're going to let you see the screen 100% here. Okay. So our agenda for today includes the following. We're going to talk about the scope. And this covers things like the inclusions, the exclusions, and the association rules. We're going to talk about acceptance. And that discussion will cover things like quality management, knowledge of your client, third-party users, the basis of accounting, and other things like that. Then we'll have performance. We're going to talk about working with client data, what working papers should include, and some other things. And then completion, and talk a little bit about the file review process, completion procedures, common errors that we find, and reporting. So this is the basic agenda and the topics we'll be covering for you today. With the compilation engagement standard, it is important to know when you are in the compilation engagement and when you're not in the compilation engagement. CSRE 4200 defines when you are in the engagement and what the exemptions are. The inclusions part is actually fairly simple. The standard requires that the practitioner be engaged to perform a compilation engagement on financial information. And that is when you are in the compilation engagement. You have to be engaged. As part of that, however, it is important to know what that financial information is. So financial information can include a complete set of financial statements, part of a complete set of financial statements, schedules of financial information, and or pro forma financial information. It is interesting to note that I'm seeing a lot of practitioners utilizing that term, financial information, on their financial statement reports. And I know this because the samples in the standard show that. But I just wanted to let you know it really is still okay to use the words financial statements if you want. I think that makes more sense to the average reader. So you can use financial information or financial statements. They're both acceptable. While the previous slide noted pro forma financial information as an inclusion, it specifically excludes a forecast or a projection, as these engagements are covered in AUG 16, which is the guideline for the compilation of a financial forecast or projection. There is also non-authoritative guidance found at the end of the accounting section of the handbook as well on the whole forecast and projection thing, or FOFI. Other exclusions named in the standard are when you're acting as a trustee in bankruptcy, you're a receiver or a liquidator. If you're acting as a member of the finance department or as a controller, so that's a good one to know. Being engaged to perform a bookkeeping service or preparing certain financial information. And that type of information includes things like government prescribed tax forms, such as T1, T2 forms, and charities forms, etc. Any financial statements that might be subject to audit or review by another accountant. Or as part of another service where the numbers are needed to perform that other service. This type of service might include the completion of forms prescribed by government or other regulatory bodies, business valuation services, or litigation support service. Practitioners need to keep in mind, however, that these exclusions only apply if the information prepared is limited to the exclusions listed. So if you're doing just one of those engagements, then you're excluded. But if you combine it with other things, you might, then the exclusion no longer applies. Then you have to think about where you are. Practitioners are often asked to perform engagements that do not come under the auspices of a compilation engagement and to provide a communication. Sometimes they believe that a communication is required, though, in order to prevent a misunderstanding. So there's different situations out there. There are no other acceptable reports or disclaimers available to the practitioner. So if a communication is required or recommended, the practitioner and the client can opt into the compilation engagement in these situations, keeping in mind that opting in requires fulfilling the requirements of the standard completely. This requirement ensures that there is no association with financial information to the accountant unless it really fits within one of the engagement standards in the handbook. So as part of that, there's a few other things that practitioners are doing that could indicate association. So basically, the standard says there's no other communications available to the practitioner. So what you're looking at is you can do a compilation, a review, or an audit, or there's other engagements in those standards that come into play. But if you're not doing one of those engagements, then you should not be associated with this information. That's basically what they're saying. And some of the things that we're finding that can indicate that there is association is where accountants are doing things like putting unaudited see notice to reader or compilation engagement report in the title of the financial statements. There should be no titles that indicate the type of engagement. You'll notice the audit engagement and the review engagement no longer has the audited or unaudited, and now the compilation engagement is the same. You should not say unaudited see notice to reader or see compilation engagement report, because we don't want any association unless the report is there. The other problem we're finding is that people are putting their company or their firm logos or letterhead letterhead on the pages of the financial statements. So again, that's association. And without the report, there should be no association. So we want to make sure that those things all come off of the statements. The only thing that should have your name or logo or any indication is the report itself. So hopefully that makes sense. So there should be no associating the financial statements with the firm unless the compilation engagement report is attached, as I mentioned, to the financial statements. And these other items should not appear on the financial statements themselves. You might have heard the term white paper financial statements. This is a term that is used when you are referring to information that is not subject to a compilation or a review of audit or an audit engagement. They're called white paper because they really should be on paper and no letterhead. So if you hear that term, you know what that means. For example, if you were preparing financial statements as a result of a bookkeeping engagement, and because the bookkeeping engagement is not being performed using the compilation standard, the resulting financial information is printed on plain paper with no letterhead. And this is why the financial statements that are subject to review, say by another accountant, the engagement is usually required to assist management in getting the statements to a level where they can be reviewed or audited. So there's no association needed or anticipated in that kind of situation. So hopefully that makes some sense to you. So what we're going to do is we got a little quiz up here. And what we want to do is make sure it's all working the way it should. And we want to put you guys to work and make sure you're all understanding and hearing okay and all that stuff. So here we go. We're going to spend a few minutes looking at the quiz and come back to you in a minute here. Okay, let's see how we made out. So in the first question, we have a new client coming to us for the purposes of doing the year-end taxes. The client is worried about cost as the company is just starting out and just wants that T2 return done. During your discussion, though, you discover that the client intends to take that T2 return to the bank because he's hoping to get some financing to increase his inventory. What would be the best course of action? The options were to prepare the T2 return as requested, or to discuss with the client that it might be better to upgrade to a compilation engagement, as the banker is likely going to want to see something prepared by an accountant. And looking at the results, it looks like you all agreed with us on that respect. So that's good. That's where you have that option to opt in as opposed to just going ahead and preparing that T2 engagement. So that's good. In the next question, your client has engaged you to do the bookkeeping. At the end of the year, he asks you to print the final copy of the bookkeeping reports on your letterhead to show that you did the bookkeeping. Can you accommodate his request? The options were yes, as long as there's no communication, or yes, if the client agrees to a compilation engagement, or no, there should be no associating the information with the firm unless a valid engagement report is attached. So the answer we were leaning towards was that no, there should be no association. However, the second option isn't incorrect either. If the client does agree to a compilation engagement, you can go ahead. So we were leaning towards the third one, but the second one is also correct. So looks like we're all on the right track there, and that's good to see. And then on the last question here, for a T2 engagement only, it's your habit to put a disclaimer on the T2 which states unaudited, see notice to reader. And the option was, is this an acceptable habit? And the answers available were yes, the disclaimer clarifies what was done, or no, that unless there's a proper engagement report, there is no other communication available to the practitioner. The second answer, the no, was the correct one we were looking for, and it looks like we're all in agreement there. So we're on the right track. It looks like we're all having no problems hearing and understanding. So we're going to move forward to the next section. And that's acceptance. So the acceptance and the continuance process is probably the most important process of the compilation engagement. It is worth spending an appropriate amount of time doing it correctly, as good documentation at the beginning of the engagement can save a lot of time during the engagement and in future periods or engagements. So this is a big step, and if we do it right, it's going to be more efficient for us as we go. So first of all, now that the Canadian Standard of Quality Management 1 and 2 are in effect for all engagement types covered by the handbook, part of the acceptance process involves making an assessment as to whether the acceptance of the engagement or the client in question would contravene the firm's quality management policies. So at this point in time, your firm should have a quality management system in place, and the system should outline what the acceptance process is. It is a good idea to ensure that you are familiar with your own quality management system to ensure that you are meeting those requirements and that the engagement would fit. Because if you're doing two different things, in the engagement and your quality management system says you should do something else, then you really should make sure that they agree with what you're supposed to be doing. And so it's a good idea to check that and make sure everything's in agreement. And as you can see on the slide here, on the left, we have Canadian Standards on Quality Management, CSQM1, which does include related services, which does include compilation engagements. And as a result of that, we do have to check the firm's quality management system with respect to whether acceptance is okay. Another thing that comes up with respect to quality management is whether the engagement requires an engagement quality review. Again, your quality management system documentation should outline what the requirements are for an engagement quality review with respect to your compilation engagements. Typically, requirements would include having an EQR or engagement quality review to reduce a quality risk, although your firm may have additional requirements. So what types of things might involve an EQR in a compilation type of engagement? So far, I really haven't seen any live examples, but I would probably lean toward things like where you might have a potential conflict of interest or a situation where your relevant ethical requirements could be at risk. If anybody has encountered a situation that required an EQR, it's fine if you want to share that with me. The EQR is supposed to be based on things that would affect quality within the engagement. So, other examples might be if you're going into industries you've never been in before, you might want to have a first file reviewed by somebody who does it, or other similar circumstances where it's new or different or very public or something that might be of concern to you. So, But again, it's based on risk and whether quality could be affected within the engagement. So hopefully that helps. And probably most of us will not see many files that would require an EQR, but at least the requirement is there, and you know what it means if you ever come across it, because that should be on your checklists and forms by now. So before we can accept an engagement, we do need to understand a little bit about our client. So the accountant is asked to obtain information or knowledge from various sources that might be helpful. For instance, additional information can come from things like online searches, references, social media sites, things like that. If this is a new client, you do want to perhaps look into the client before the acceptance process is complete. Even ongoing clients might need a little bit of a look into as well, based on our previous experience. If we've had problems dealing with them collecting fees, you want to, include that information in your knowledge of your client. What you're watching for here is things that might provide information as to the character of the client. Is there any reason to doubt the character or the integrity of your client, including management and owners, and how doing business with them would match your own ethical standards? So are these people you really want to be doing business with? Reputation risk could be a factor, considering whether attaching your name to the client could result in any negative association or an incorrect level of reliance on that association. And then consider, what about the nature of the information that will be supplied by the client? Now, we've pretty much addressed that, but here we ask you to consider it again. This helps us understand the information that will be provided, whether any additional information needs to be gathered, and what additional information management may have to assist over and above the bookkeeping information. So what's available there? If this is a new client transferring from another accountant, there should be a discussion about the reason that the client is changing accountants. And that reason might affect your decision, whether it's a dispute over fees or if they were incompatible, or maybe the accountant's retiring, or there's different things that could be involved there, as we all know. Also, we cannot forget that a takeover or a communication is required under the Code of Conduct. This has been an area where there are more complaints and cases with respect to client takeovers from both sides. And if you ever see the releases from the provinces with respect to where their ethical cases or where their complaints inquiry cases are going or coming from, you will see more of these things coming around. One side usually being that the predecessor accountant was not properly advised, and the other side usually involves things that the incumbent accountant is not getting the correct level of cooperation from the predecessor. So there has to be balance, of course, between the correct amount of cooperation and asking for too much. I always tell people, don't forget that accountant is losing a client. They're not getting a fee now from that. So don't overdo the request for information. Your client should have most of that information already with respect to the compilation engagement. And if they don't, that's usually an indicator that the client hasn't even looked at the prior year stuff. But yeah, keep that stuff in mind when you're doing those takeover letters, and what is the correct amount of cooperation back and forth. Don't forget that a takeover letter should be included in the file. And don't forget that in the event of no response, an appropriate level of follow-up should be required. Don't just leave the letter in the file and don't act on it. There should be, if you don't get a response, there should be a subsequent phone call, perhaps an email. And then if there's still no response, then you need to conclude and record it in your file as to why you're accepting the client, or even not accepting the client. But usually we have to move forward. So typically you're going to see that the file goes ahead. But we should remember to document that if they didn't respond, what did you do to follow up on that? And why did you decide it was okay to continue with the client? I'm trying to think of cases where some accountants don't want to cooperate. Usually it's because they are losing a client. You know, sometimes the predecessor might refuse to cooperate until their fees are paid. And unfortunately, what we're finding in the CIC cases or the discipline cases is that's not a good excuse. You have to act in the best interest of your client. Um, Sometimes the predecessor does not provide the required information. Again, if it's needed for whatever reason, and we've had a lot of really bad situations, weather, floods, fire, all that kind of stuff in various areas of late. There could be situations where records get destroyed or lost, and so sometimes we do need to provide those records. If we're asking for too much information as the incumbent, let's be careful and keep in mind what we feel like when people are taking over clients from us as well. So there's a little bit of an idea of the kinds of situations that might create no response, and hopefully, hopefully we don't get into them. But if we do, just remember we have to do that follow up, and let's keep the whole cooperation and reasonability thing in mind as we're moving forward as well. If we're meeting with a client, whether it be for the first time or in preparation of a continuing engagement, we need to think about the client and the various things about the client in order to assess whether we are going to accept them and the nature of the work to be performed. And that's based on what we know about them or the questions that we're going to ask them. The process of acquiring knowledge may include several steps along the way. And we may not get everything we need at once. So we have to keep that in mind as we're moving ahead. But the use of checklists and forms can help us to remember what we're looking for and what we need to think about. So there's various checklists out there and lots of forms. And for our purposes today, we're going to use the Ash Grove Learning Forms. That way I don't get into any trouble or conflicts with anybody else. And it gives us a guide. The end result for all the various forms is pretty much the same. These forms all look very similar. So hopefully it won't be that far different from what you're used to seeing. So in our case, in question 2A of our compilation engagement checklist, you would be asked to summarize what you know about the potential client, including the nature of the operations, the industry, and other related services that may need to be performed. So it's easily documented in a form, like I say, similar to this one. The forms are all somewhat similar. Um, and I think we're all used to filling in these forms. And if you see what I would like to do is in that description section, the description in the business and highlight a key operations, it's okay to use more than one word. It's really important that the reader, the outside reader of this information, who isn't in your head, would be able to understand what this business is doing. So if we can get a little bit more information there, I do find that is a little bit of a weakness in some of our documentation. But yeah, more than one word's okay anywhere within the file. And if you need more room, add a section, add a memo, whatever, to help you with respect to your documentation. One of the first requirements is what we call preconditions. We are required to inquire of management about the intended use of the financial information, including whether that information is intended to be used by a third party, and to obtain an acknowledgement from management of the basis of accounting expected to be applied in the preparation of the compiled financial information. While we are going to talk about this more a little bit later, one of the things we are finding now in file preparation is a true lack of evidence of discussion or inquiry. To that end, we have designed a form to help document the required inquiries of management. And this form is, it could be used as an agenda for a meeting or as a questionnaire that you send to the client for a response. This information will be used to complete some of the knowledge documentation in the file. And you also might find that the client needs you to help with some of the responses. The questions here might lead to additional questions depending on the responses from your client. And as a firm, you might have other questions that you want to ask, which could be included in such a form or a memo. The important part here is actually having documentation that shows that we have talked to our client and properly gone through the steps that are required in the compilation engagement. Um, so in this case, we're using the new client example. We would have something similar for an ongoing client. But why are we changing accountants? What does your business do? Uh, have there been any changes in the products or services in the past year? So this discussion, would occur even with your continuing clients. You are expected to talk to your client every year. You don't take them in the 1 year and talk to them 10 years later or 5 years later. We are expected to ask these questions every year. What will you be using your financial statements for? That's your first clue as with respect to third parties. Do you expect to give these financial statements to other parties? And if so, why? If you expect to give the financial statements to other parties, do those parties have the ability to obtain more information or agree to the basis of accounting? Now, this suggests that if you have third parties that you're going to be giving the financial statements to, the relationship already exists or is on the hinge of existing. It's not going to be distributed to people in general. You have particular bodies in mind, or the client has particular bodies in mind. So this is a key question. We're not putting out to 20 lenders or 5 lenders. We might be putting it out to the company's lender, existing lender, or banker. So think about that difference as you're going through the questions in your own checklists. And then what is the expected basis of accounting going to be? And do you expect that to change from the previous year? So another key question with respect to this is because what's happening, and we're probably going to cover this again, but what's happening is the firms out there are trying to be efficient. So they've got a template basis of accounting they're distributing to their clients and they're asking them to sign it. Well, that's not what this is about. This is about what does the client want on the financial statements, and what is the basis of accounting going to be based on what the client wants on the statements. You're probably going to advise them in that regard, but this is not about your template. This is about management and their decisions. So a very key one to keep in mind here as we move forward. As we move into our checklist, our 2B asks us to summarize what you know about the books and records and any other information about the nature of the information that will be available so that you will know if more information is required. So what we're finding now is that documentation about the books and records is often either very good or very poor. When you're documenting what you know, you need to keep in mind, again, that an outside professional with a similar background as you would need to have enough information to be able to reperform your procedures and to come up with a similar result. The standard also requires that the information is sufficient to be able to perform the engagement. So the required information is with respect to the business and operations, its systems, and accounting records. So let's review the beginning section of our knowledge part of the form and see what kind of documentation would be useful. This first part addressed the accounting or the bookkeeping software used. This question seems straightforward enough, although when software is not in use, there should be a detailed description of what is done. In our example here, we're indicating that we're using QuickBooks and it's the online version. So it's not saved necessarily on the hard drive, it's more in the cloud. For instance, if spreadsheets are used, the information should be clear enough that we can figure out how the spreadsheets make their way to a trial balance, a general ledger, or a financial statement. Saying that the client uses spreadsheets is not enough. It doesn't tell us how we get all the way to a financial statement. So we have to think about what types of spreadsheets are out there. We have double entry types of spreadsheets. We have single entry types of spreadsheets. We can actually have true subledgers. There's still even manual GLs and subledgers out there. So when we're talking about this type of thing, we have to know how we get from that spreadsheet all the way up into the financial statements. And it could be as simple as the client provides us with their one rate or um, check or disbursements ledger and revenue ledger, and then somehow you match it with the Visa cards and the bank statements and move it all the way to a trial balance. So if that's the way it is, that's what you have to say it is. If the client brings in a shoebox, how is that information recorded so that at the end result is a trial balance? So don't just say you guys do the write-up, say how you do the write-up so that anybody else that was doing it would be able to get to the same point if they did it the same way. Quite often the responses in this area are overly brief and they do not provide the information that is needed. Like I said, if you just say that we do the write-up, it's just not okay. How is that done? What software are you using? How do you convert that? Do you start with this? Some people start with spreadsheets. Some firms use QuickBooks. Some firms use Sage. Some firms go directly into Caseware. So we have to know how you're doing that type of thing. Once we know what accounting software is in use, then we need to address the different accounting cycles. It's not enough information to know that you're using an accounting software. We all know that these softwares out there come with various attributes and specialty applications, and not all bookkeepers and not all data entry clerks enter information the same way. So on the slide in front of us, if we're looking at the revenue, the receipts, and receivable cycle, and here the question asks if a software subledger is being used for this cycle. And this is useful information. It kind of lets us know a little bit more about how that information is getting into the program. If we're using the software subledger system, then we kind of know that, okay, receivables are being tracked in some way. If the software used for the subledger is not the same as what is used for the general ledger, there should be information about that as well. I've seen various files over the last little while, and in some more complex entities, where there are different applications working together, which somehow end up in the general ledger, but there's no description as to how. So sometimes people are relying on a point of sale system that comes together with the subledger and the GL. So if that's the case, we need to know about it. Inventory management systems might be in place, those types of things. So something to keep in mind. And then briefly, you should explain how sales are made and recorded. For instance, how are sales initiated? How are invoices prepared? Is it point of sale or whatever? In our example, we are talking about an auto repair shop. And you can see that there are only a couple of sentences that describe what happens, but you can also see that the information is quite informative. We address the sales side first, and then that's the easy part, but we also need to address the other side of the transaction. How is revenue received? Is it normally by cash or check, credit or debit, point of sale, EFTs? So there's so many options for payment. So when they're made, how does that get entered into the accounting system? So again, if we're using a point of sale, how do we reduce the receivables? Or is it mostly by EFT? How does that get tracked? That kind of thing. So just a little bit more information, which covers both sides of the cycle, the actual sale part of it, and then the collection of the fees for that sale. And you can see from the information, there is enough information to understand that revenues are likely posted fairly consistently, depending on the information we have about the bookkeeping staff, which we're going to talk a little bit about. And then the client likely may not need a lot of assistance in this particular area based on what I can see in front of us. The remainder of the knowledge checklist we just looked at covers each major cycle, and it tries to get information about both directions of the transaction stream. In addition to revenue, receivables, and receipts, we cover purchases, payables, and payment, payroll, inventory, and journal entries. This information is important because it will give you, the practitioner, an impression as to where information may not get recorded correctly or where the client may need assistance. For the journal entry section, I often see situations where the accountant appears to include all entries as journal entries. Then the resulting information does not make sense. If they're using the purchases cycle and the receipt cycle correctly, then when we talk about journal entries, we're talking about actual month-end journal entries, reconciling the bank entries, stuff like that. Amortization, if they're doing that. Understanding what the types of journal entries are helps where the client may need assistance. And that's the purpose of this, is where is this client going to need assistance? Unfortunately, it is very common to see overly brief, one-word types of responses in these sections, which is not adequate for the purpose of the compilation engagement. Hopefully, though, with this explanation, that you can see that there's not a lot of detailed information required either. A couple of sentences with the right kind of information will help with a more informative result. Our checklist then goes on to ask how reports are generated. For most bookkeeping software, these reports can be automatically generated. However, when it comes to things like the spreadsheet or the write-up, as we talked about earlier, there needs to be enough information so that we can understand how we get from point A to point B. Again, from the spreadsheet to the trial balance. The ultimate point is in gaining an understanding of where that client may need assistance. And then finally, we ask, based on the knowledge of the entity, using our current and our prior knowledge, is that you assess the bookkeeping system and the level of involvement that will be needed to compile the financial information. Two thoughts here. The knowledge also includes knowledge of the person doing the bookkeeping and the knowledge we've gained from doing prior year engagements and our current year's knowledge. So if all of this is properly documented, we would know what the bookkeeper is good at and what is not done, or what the bookkeeper is good at, what the bookkeeper is not so good at, and then what isn't done at all. We also consider what types of entries were required last year that might need to be made this year, and what additional kinds of entries might be expected or need to be made based on our new knowledge. For example, many of our clients do not record amortization or an allowance for bad debts. They leave that up to us. Many bookkeepers are bad at recording asset purchases correctly. So we might know that that's an area that we have to look at. Some transactions, such as reorganizations, are over the heads of the average bookkeeper, and they might not even know about it. So that's something to think about. And then many bookkeepers might be really good at data entry, but might not be good at payroll. So this type of knowledge helps us to anticipate the assistance that our client needs. We also have to keep in mind that any entries that would be required have to be with the purpose of ensuring that the financial statements are prepared in accordance with the basis of accounting. And this information all needs to be gathered with the end result in mind. So we are going to spend time on the basis of accounting so that this all comes together. But let's finish off our knowledge of client first. If this is an ongoing client, consider what may or may not have occurred in prior engagements that might impact your decision to continue with the engagement this year. For instance, did you have problems collecting your fees, or did you have disputes over fees? Was the client forthcoming with information? Were there any significant issues with how the client treated your firm members? This section so far has been getting to know the client. And as we mentioned earlier, information may come together at different times. So you might have to go back and put more on information on these forms later, but it's critical to the client acceptance process. So now we're going to address acceptance of the engagement directly. Engagement acceptance involves the use of professional judgment because the practitioner ultimately has to decide whether to accept that engagement or not. There are several conditions in this area which are covered off on most of your common checklists and forms. But one of our first questions in this area is to ensure that you know if the client understands the limited nature of the work to be performed. Because there are technically no procedures being performed in a compilation engagement, there's no verification or testing and no form of assurance. It is important that the client understands that and the fact that the engagement may not meet certain regulatory requirements. It does not mean that you need to have a conversation, or no, I apologize. It does mean that you need to have a conversation with that potential client, especially if they are a new client. And this is certainly also a good reason to reconnect with the client in subsequent periods. We also need to ensure that the engagement was not originally meant to be an assurance engagement. Sometimes there can be a tendency for the accountant or the client to recommend downgrading an assurance engagement due to problems with records or other issues. An assurance engagement should never be downgraded unless there's a valid reason to do so. For instance, most common case I encounter is when an operating company changes to a holding company due to winding down, or in the case where the financiers no longer need assurance engagement reports due to the fact that the debt repayment has happened and the lower the risk. Ensuring that the client understands the nature of the engagement could save you a lot of grief after the fact with respect to any reporting requirements for potential users. We have seen on occasion where the client had to return to the accountant and upgrade that original compilation engagement due to the fact that the proper considerations were not made with respect to those potential bankers, investors, or buyers that management was intending to distribute the financial statements to. So sometimes it's just worth asking that question. So let's not downgrade, and let's also make sure that that we're doing the right job for the client. The previous slide comes hand in hand with this next requirement to inquire of the client into the intended use of the financial statements. Financial statements prepared under the compilation engagement standard are expected to be used by management for management. That is the underlying understanding. However, we all know that management sometimes distributes the financial statements to other parties. By asking about the intended use, you may find that the client is looking to distribute the financial information to the banker or another party. So that's why we have to ask that question. Those other parties we call third-party users. So if you hear that term, that's what we're talking about, is who other than management is going to be using that. And on the chart, you can see here who some of those potential third-party users could be, depending on what the business is doing and what their needs might be. Because financial statements prepared under the compilation engagement standard are generally not done using a general purpose framework, such as ASPE or ASPE for not-for-profits, they are typically not informative enough on their own to meet the information requirements of users who are not management. For this reason, it is important to find out the intentions of the client. That is also why, if there are known other users, there needs to be an understanding as to whether the other users have access to additional information or if they agree to the basis of accounting. And notice that the emphasis of the word or in this chart. So we've got the chart here, and we've got the ability to obtain additional information or the agreement to the basis of accounting. It is noted that users are generally to consider to be known at this point. The banker or the investor would already be known when this question is addressed, meaning that a conversation can occur to be able to attain the understanding of this choice. So the client can't agree unless they know who the user is. So that's what we're trying to say here is that at this point, we should know who that third party user is. If the users are unknown but intended, let's say to a group of bankers or investors, then the compilation engagement is not sufficient, as the choice of what else the user might require cannot be known ahead of time. In that event, the choice is to do a general purpose financial statement, such as using ASPE or ASPE for not for profits, or to decline the engagement. So that's why we try to tell people that we have to know ahead of time. We can't think about some unknown party in the future. We have to talk about who we know it's going to. And I will note, practitioners do need to keep this in mind when they're getting into drafting those engagement letters as well, and other documents in the file, because this information is not getting customized properly. And you know, that can almost put you offside with practice review. If you're not careful about those engagement letters and describing the fact that the third party user is known, then you could be getting yourself offside because you might be pushing yourself into that general purpose financial statement. So be specific as possible without being, you know, you don't have to name the parties individually, but be specific. Talk about the company's banker or company's lender or something in general, so that it doesn't look like you're opening these financial statements up to several unknown parties. So that's what we're going to hear. We talked earlier about the intended use, and this process is considered to be a precondition to the acceptance process. So we have to do this before we make our decision on accepting. The next topic that we promised to come back to is regarding the expected basis of accounting. The compilation engagement forms and questionnaires out there will ask about the expected basis of accounting. So now I want to spend a little bit more time with you on helping you get this part right. The standard refers to the expected basis of accounting at this time because there is the understanding that once the engagement commences, there could be changes as to what was expected versus what actually ends up happening. This terminology allows for that type of change. And I mentioned earlier that there are those canned templates or forms that are in circulation that practitioners are having their clients sign with respect to the expected basis of accounting. But the use of these forms without proper knowledge and consideration is creating problems in compliance with the standard. The problem or the issue is that every client is different. And no matter what your firm policy might be, the decision on the basis of accounting does not belong to you. It belongs to management, and it must be discussed with management. This also means that the practitioner may have to explain what that basis of accounting is to the client and perhaps help them make a recommendation in order for them to be able to agree to it. And that's when you're helping them with your professional judgment. We know that there are many variations for the presentation of financial statements in the compilation world, especially after the old notice to reader. The purpose of having a disclosed basis of accounting is so that the reader or the user understands how the statements were prepared, as opposed to guessing at what might be missing or not even knowing that things could be missing. With general purpose financial statements, all that information must be included in them. You know, if we're following ASPE or ASPE for not-for-profits, we're following the rules and we're making sure that those financial statements agree with ASPE or ASPE for not-for-profits. We're making sure everything is in there correctly. In the compilation engagement, though, if something is not presented, it is not necessarily considered to be misleading if the statements are prepared using the client's policy, which is disclosed as the basis of accounting. So we can see how statements can be different in certain industries as well, and in this regard. Consider, for example, the farmer who often used a cash basis only, where other farmers used a hybrid version of cash and accrual. And then you get, um, and then you get, if they're doing full ASPE, then you have the full accrual method in play as well. So the farmers are the best example I can think of because they can be so different. The compilation standard allows for either or as long as the reader can understand that there is a difference. An accounting framework such as ASPE or ASPE for not-for-profits really is a basis of accounting if you think about it. And when we're doing a compilation engagement, we usually do not use these types of frameworks because of the cost and the complexity. As a result, that's why we have the decision is to disclose the basis of accounting and why it's useful to readers. What is happening now, though, is that the accountants don't understand it. They don't understand what the basis of accounting is. And often the disclosed basis of accounting contradicts or is not complete as to what was actually done. So what is the right thing to do, or where do you start? Definitely not with your CAN template. I really recommend just throw those out or make them so they're easy to manipulate and change as you're going. If you're dealing with an ongoing client, look at the financial statements that were prepared last year. Start with that. If it's a new client, go over the types of things you would normally see with that type of entity and talk about it with the client and find out what their preferences or their needs are. Our questionnaire asks the practitioner to describe the basis of accounting. If this has been documented somewhere in a letter or a memo, then a cross-reference is a great way to link that information. Otherwise, the information should be fully documented in the checklist or elsewhere in the file. So let's look at our basis of accounting history form. We created this form as a way of permanently recording your conversation with your client so that it can be carried forward in subsequent years and updated as required. The basis of accounting generally starts with the costing method. And basically, we're all typically using historical cost, which is most commonly used, potentially fair value accounting or some other costing basis on the balance sheet. But most people seem to be able to get this part right. Then we need to consider what accounting method the client is using. It could be a cash basis or an accrual basis or a combination. Typically, our clients tend to use a cash basis and pick up some accruals at year end. But often with off-the-shelf software, if the client can be using a modified accrual basis, depending on the knowledge of the bookkeeper and whatever. So you need to keep those types of things in mind. And full accrual means that the client is totally using that proper accounting framework, such as ASPE. So be careful as to how you address the accrual part. So if I was filling this out for a client and we're not using anything but a simple basis of accounting, I don't think I would go full accrual. I think I would use simple accrual, which helps catch the things that might need to be paid or made. Once the method of accounting has been determined, the rest of the information needs to be completed correctly. If it is a cash-only basis, then there typically are not going to be any accruals. That means that the balance sheet will likely show only cash and only equity. With a modified accrual basis, there may be some items set up, but some that are not. Consider how many of your clients set up accounts receivable and payable, but not future tax. What's important to keep in mind is that your client is recording an item on the balance sheet. And if they're recording that item on the balance sheet, that item needs to be included in your basis of accounting disclosure note. We're quite often seeing practitioners prepare those notes that only disclose a couple of standard items. We're seeing cash plus receivables and payables. But then when we look at the balance sheet, we're finding loans receivable or payable, prepaid expenses, property, plant, and equipment, inventory, due to and from shareholders, taxes payable or receivable, and other items that are not included in the disclosure. The biggest hint I can offer is if it's something that you're going to put on the balance sheet, it should be in the basis of the accounting note. Shares and equity are generally not included in the disclosure because that's part of your original cash basis. Once the item has been included in the note, there may be occasions where you want to mention or disclose the accounting policy being used, especially when there are options. For instance, how is inventory costed? How is property and equipment amortized? These disclosures are usually pretty brief, but they give you useful information as a user or a reader. This area is where most deficiencies seem to occur in the compilation engagement and where more consideration needs to be made. It helps the practitioner understand how the bookkeeping system, which we have just documented, may or may not be sufficient for preparing the financial statements and display where the accountant may need to assist management. That's the whole purpose of doing this knowledge of client. It's critical that the information here be linked to the checklist and the knowledge of business so that the proper procedures can occur. And as an example, the bookkeeper might be good at recording property and equipment, but may not do the monthly entries for amortization expense if this is the chosen accounting policy, which means that you would need to assist in that area. This information will also help point out any areas that require significant judgment from management or whether you need to assist them, again, such as amortization rates, costing methods, or estimates. Note, it is expected that the accountant may assist the client with certain significant judgments, such as what the basis of accounting should be and what accounting policy choices might be best in the circumstances. When you assist management with significant judgments, such as those just listed, you need to discuss it with management so that they understand the impact on the financial information and so that they can accept responsibility for them. And I do recommend carrying the history document forward to future engagements as it properly documents your original discussion with your client. It gives you an opportunity to discuss and review it with your client on continuing engagements and to ensure that any updates and changes are also properly documented. And I'd just like to point out that in this example, things that I would probably be adding now are things like income taxes payable and receivable due to or from shareholders or related parties. They're not there, but they probably could be added because a lot of people do that. Do not for a minute think that the accrued receivables or payables is going to cover everything on the balance sheet because it can't. Then you're getting into an accounting framework. So you really do need to be specific in detailing what they are because we don't know what you might have missed. Like, for example, future tax is the easiest one I can come up with, but maybe there's some deferrals or stuff that we're not setting up, like deferred revenue or other types of things, or maybe we don't do amortization. So that's why this is important. It has to agree with the balance sheet. And when you're doing your basis of accounting and when you're doing the compilation engagement, you're helping your client get to this basis of accounting. It's not the other way around where you choose it for them. You decide what that basis of accounting is, and that's where you're going to get to. And that's why we need to know what the books and records are like so that we know where the weaknesses are and where we need to pick up the differences. We wanted to provide you with an example of what a typical basis of accounting or accounting note might look like. And, there are many variations out there, but typically they would look similar to what you can see on the screen. One thing that does get practitioners into trouble with practice review is when the basis of accounting refers to GAAP or to an accounting framework such as ASPE. The only time you should be referring to ASPE or to GAAP is if you are using the full accounting framework with all of those required disclosures under the standard. And again, I would remind you it's typically not done in the compilation engagement. There is no such thing as ASPE minus or ASPE less, and anything less than a full accounting framework is not considered to be GAAP. So in the compilation engagement, just don't even refer to those words. Another consideration as to whether there might be any factors that indicate that the financial information could be misleading. Once again, this involves your knowledge of your client and the bookkeeping systems and the basis of accounting. You need to consider, would something appear to be misleading if it's not addressed? This might apply more to areas where omission of an item would cause the statements to be misleading or vice versa. And the best example I can think of here might be, let's say, setting up or accruing one side of a transaction type, such as accounts receivable or inventory, and not setting up the corresponding transaction type, such as the sale or the payable that arises from the other side. So this could lead to the need to assist the client further and to potentially ask for more information. You need to decide if there are any reasons not to accept the engagement. Everything you've done up to this point is a precursor to finally being able to decide whether you're going to accept this client or not. At this point, there is the assumption that there has been some discussion with the client and that the client understands the terms of the engagement. The standard requires that the terms of the engagement be agreed upon prior to performing the engagement, and that management acknowledge that in writing, that they agree to those terms. And so this makes the final part of the acceptance process to document the terms of the engagement in an engagement letter and having it signed prior to commencing the procedures. Note prior to commencing procedure. So that's causing a lot of trouble as well. Different firms have different policies with respect to obtaining engagement letters. Many get the client to sign one annually, and some firms have it done less often. Different firms have different policies with respect to obtaining engagement letters. If your firm does not obtain engagement letters on an annual basis, you will need to assess whether the client needs to be reminded of the terms of the engagement as part of the annual consideration of engagement acceptance. The annual consideration involves an assessment of whether there are any factors that would cause a need to remind the client of the terms of the engagement. Those terms would definitely be significant, such as things like changes in ownership or intentions with respect to the business. If your firm does not have an annual engagement letter, you will need to document the fact that you considered whether a new letter was required in your checklist and to cross-reference to where that engagement letter in question can be found. We highly recommend that a copy of the actual engagement letter be in the working paper file because this is a condition of the engagement. So when you have technicians out there doing these engagements, we have to know that everything is complete. The engagement letter is a pretty standard form, and its main substance or content should not be changed in any material way. Many firms do add additional clauses to the basic engagement letter to suit their additional needs, but the basic part should never be removed or altered. It is, however, important to ensure that the engagement letter is properly customized to the nature and the circumstances of your client. We have seen many errors in this regard, and common errors in the engagement letter include things like omission of the fact that there might be third-party users, or if the third-party users exist, they're not properly being described. You know, we have those form letters and they leave that section where you can change it to what you want. Well, make sure you change it to what you want or what it should be. The agreement of third-party users has not been properly customized with respect to the either or option. So both options are provided in the templates, but you have to decide what one is important for your client. People are missing the sample report with their engagement letters. So some engagement letters have them within the body of the letter. Some of them have them as an appendix. Make sure that it's there because practice reviewers look for this stuff. The terms of the engagement, whether it's 1 year or ongoing, has not been customized to the actual letter or agreement. So if you make the engagement letter for this year and you don't have a survival clause within the engagement letter, then the engagement letter does not apply to that following period. So make sure that's covered. And then, of course, lots of other customization errors within the context where you're using a templates, but you're not reviewing them properly before they go out the door. As we mentioned, the engagement letter is supposed to be signed prior to the commencement of the engagement. As such, one expects to see a valid signed copy of that letter for the year in question in the file. Unfortunately, it's common to see engagement letters dated for the prior or subsequent year due to office procedures not organized enough to ensure that the documents make it to the correct file. So sometimes this is worth a little extra attention, and it could save you a deficiency in practice review. And the other item to note is with respect to the signatories. Sometimes you can have an entity where management and those charged with governance are not the same people. In these cases, because acknowledgement is required from management, you may need more than one signature on an engagement letter. So that's another important one to think about. A quick note on independence. This webinar, we're not going to talk about independence in detail because our other courses that we have already do have a lot of detailed information in that regard. However, we do want to reiterate the importance of assessing independence to ensure that any disclosure requirements are being met. Our checklist takes you through the independence prohibitions, and if they exist, disclosure is required in the compilation engagement report. The checklist also takes you through the threats to safeguards or threats to independence so that if there is a significant threat, safeguards can be put into place to ensure that the disclosure is not required. Documenting the assessment is a very important part of the engagement, and it's not necessarily covered in the standard itself, but it is addressed in the code of conduct. The acceptance process exists through the entire engagement. So should something come up during the engagement that might have caused you to decline the engagement if you had known about it earlier, you do need to follow procedures with respect to that issue. Keeping in mind that the acceptance procedures and when things come up, issues come up, your system of quality management should be providing you guidance as to what you could or should do. Okay, we've covered acceptance now. So what I'm going to do is bring up our next quiz. And I think we're about definitely halfway through here. So why don't we give you some time to do the quiz, and then we'll, instead of 10 minutes, we'll give you till 5 minutes before the hour. So it gives you almost 15 minutes. So we'll let you do that, and we'll come up again about 5 minutes before the hour. So we'll talk to you soon here. This is your 1 minute morning. Okay, welcome back, everybody. So let's look at our quiz here and see how we made out. We're just finishing off the acceptance part of the webinar here. So in question 1, you're meeting with a potential client, and this client has a high public profile. It's come to you to perform a compilation engagement year-end, and the business is in an industry you're not necessarily familiar with. What should you be considering? The options were upgrading to a review engagement, consider the need for an engagement quality review, or there are no issues and this is business as usual. And it looks like we're all very comfortable with the correct answer, or at least the one we were leaning towards, which is considering the need for an engagement quality review. So I'm glad to see that you can understand that engagement quality review could be required in a compilation engagement. In the next question, a new client comes into the office and drops off the books and records. The client advises your receptionist that he needs you to perform a compilation engagement. He signs a pre-formatted engagement letter as he's in a hurry. The receptionist receives the information, posts the engagement in the queue for preparation. What might have just occurred? So the options here are the firm has a new client. The firm's acceptance procedures may not have been followed. The firm's acceptance procedures under the system of quality management may not have been followed. The client may not fit within the firm's desirable client profile, or the firm may not have met the requirements under the code of conduct regarding takeover from another accountant. So as far as those options go, the one that does not belong is that the firm has a new client. So all the rest of those responses would have been correct. And it looks like for the most part, we all agree with that. Because the acceptance procedures may not have been followed. Like I said, you do have to talk to your client and there are preconditions and all those things. So you guys all agree with that, and that is good to see. In the third question, the description of the bookkeeping system for a compilation engagement is described as follows. The company uses QuickBooks. Revenue is recorded by the bookkeeper once a week. Invoices are posted when the owner pays them. Payroll is done bi-weekly. Do you consider this to be adequate documentation in a compilation engagement? Yes or no? And the correct answer, and we agree with that, is no. In question 4, in the above case, what additional information might have been helpful? And we have a list of items here. Is the software a desktop version or an online version? Are subledgers used at all? How is revenue generated and invoiced? How are receipts made and posted? How are purchase invoices posted? How are purchase invoices paid and posted? Is there any inventory? Is payroll calculated and posted using the QuickBooks program, or does the client ever post any adjusting entries? And what we were looking for here was all of the above. So, so all of those would have been good information to add to the information about the bookkeeping system. And looks like we all agree. So that is great. In question number 5, the knowledge of client indicates that the bookkeeping is outsourced to a contractor. What additional knowledge do you need? And the options were nothing. The contractor is a hire for service and should know how to do bookkeeping. Or what is the knowledge and experience of the bookkeeper? And again, we agreed with the correct answer, which is what is the knowledge and experience of the bookkeeper? Without that, we won't know how to assist our clients. So that's very important. In question number 6, your client wants you to perform a compilation engagement. His intention is to distribute the financial statements to potential investors. The client indicates that all potential investors are able to agree to the basis of accounting. What are your options in this case? And the options available are to accept the engagement on a compilation basis, or suggest the client upgrade to a review engagement, or suggest the compilation be conducted using full ASPE as the basis of accounting, or to decline the engagement. So depending on where you are in this conversation, the answers we were looking for were the last three. You can't accept a compilation basis if you're sending the financial statements to a bunch of people we don't know who they are yet. That's the whole point we're trying to get across here, is you have to know your users. So I would say that you probably should not accept the engagement on a compilation basis. But I would definitely suggest that the client upgrade to a review engagement, or to conduct the compilation using full ASPE as your basis of accounting, or the other option would be to decline the engagement. And the reason being is here that what we're trying to get across is we have to know who our users are. We can't have a group of unknowns out there. We need to know who our users are. They need to be able to answer that question when you agree to the engagement. So if they're not known, they cannot answer that question. And if that makes sense, hopefully it'll get the point across. But that's what we were looking for there. And it looks like we might have misled a few people. So think about that one as we're moving forward. In question 7, the basis of accounting note says that the financial statements are prepared in accordance with Canadian GAAP on a cash basis, with the inclusion of accounts receivable, accounts payable, and property and equipment. Would this be an acceptable basis of accounting under the compilation standard? The options were yes or no, and we all agree that no would have been the correct answer. And then finally, in our last question, the engagement letter for a client indicates that there will be various third-party users who have agreed to the basis of accounting and are able to obtain additional information. Is this comment in compliance with the compilation engagement standard? And the options were yes, the users need to have those options, or no, specific users need to agree to one option or the other. And we were all correct with the correct answer there, which is no, specific users do need to agree to one option or the other. So I think we got that point across. So it looks like we're in good shape. And I may have forgotten to mention as we move to the other side of this webinar is that if you do have questions as we go, there is the chat function and there is the question and answer function on Zoom. So if you do have questions as we go, please don't be afraid to ask me questions. If I don't get to them right away, I will get to them before we close out for the day. So hopefully I don't know if I mentioned that when we first started. So if we got it now, hopefully I can answer your questions if you have them. All right, let's move on to performance. Performance requirements stated in the handbook are to assist the client in preparing the financial information, which includes a note that describes the basis of accounting. As we all know, though, performance of the engagement is usually a little more than just preparing the financial information. One of the assumptions to this is that the financial statements of the end of the day agree to the underlying records. So I think it is important to talk about what might be in a typical working paper file and what those underlying records might be. A compilation engagement generally begins after the bookkeeping is done. So for many compilation engagements, however, the engagement might involve having to do a certain amount of bookkeeping, or write-up as we call it, just to get to the file to the stage where one can get to a starting point to be able to do the compilation. It is recommended that the bookkeeping or the write-up part of the engagement be treated almost like a separate engagement, and that you will likely have a separate file for addressing the bookkeeping and the related backup to that part. or the bookkeeping part will be kept separate from the compilation part, let's say at the end of the working paper file or in a bookkeeping folder, depending on how you prepare your files. The standard expectation is that the compilation file engagement will generally begin with a trial balance or a general ledger. As part of assisting the client, we may have to look into certain areas and help the client prepare adjusting entries in order to get the result of having financial statements that comply with the agreed upon basis of accounting. And for this, we do need to have a working trial balance, which shows where we started the engagement from the records or the bookkeeping to that final result. It is a key document in the working paper file, and unfortunately, of late, I've seen a little or a few more files without a working trial balance in them. So for some reason, they're just not there, but it is an important part of the file because we have to show our starting point and how we got to our ending point. And our documentation in the file will show how we got there and that it was approved. So hopefully this chart will help you a little bit in also defining the difference between the bookkeeping and the compilation. The other side of the coin is what often happens is the write-up is done and then we have 12 months of bank statements in the compilation file, which is totally inefficient and unnecessary. So that type of thing, we're just trying to delineate the difference so that you don't get confused as to what part of the engagement is in fact happening at a point in time. General standards also just suggest that each major area of the balance sheet be supported in some way. On the slide, we're showing an examplation of a compilation file index, and you can see within that index that there is a place designated for all of the major categories that might be included on the balance sheet. These are included under the assets, liabilities, equity, and income statement headings. Ideally, the file will contain lead sheets for each of these major areas that are applicable to the client and the basis of accounting. The lead sheets typically summarize the accounts that make up the major line item on the balance sheet and are a reference source to any backup that is in the file. Alternatively, some practitioners prefer to use a trial balance as the reference source, which is customized to show the groupings by each line item and is also referenced to the backup working paper. So either or is acceptable. Notice here, however, how each section has indexing in a logical order. I have noticed people are putting together files that are very haphazard where working papers are in one section of the file, lead sheets are in another section of the file, if at all, and there's really no tie-in or system that makes logical sense. So if you follow a logical system, it makes everything easier to find as you go, and that results in efficiency. So just a quick thought or comment there. Backup might consist of things like a reconciliation or a listing that shows an agreement of the balance in the books to the underlying records, which agree to the items in the lead sheet. These also may be supported by additional records, which show the source of the reconciliation documents when it's important. In our example, we show lead sheet A, which is typically the index used for the bank. The main supporting document here would be the bank reconciliation, which would be indexed perhaps as A-1. And if there are multiple bank accounts, then A-2 and A-3, etc. could be used. Then a bank statement that ties to the bank reconciliation might also be a good document to have in the file. Note that every item in the file, every page should have an index number. Ideally, indexing should make sense and follow a pattern, even though there does seem to be some confusion of late. The index on the previous slide is a good example of a good indexing system. Many firms have standard formats that they use, and they would be similar in nature. Note also that when balances carry to or from one document or another, that those numbers should be cross-referenced as appropriate to the working papers that they go to and where they come from. This makes finding items in the file efficient, and it helps to ensure that the file stays organized. And while it's nice to have supporting backup for a balance, we do not need to have copies of items for everything. For instance, we do not need a copy of each invoice of the receivables listing or every item on the accounts payable listing, even though we might want a copy of the year-end bank statement, which supports that reconciliation. Not all 12 months, though. We have noted a tendency for compilation files to get really heavy because of this mountain of excess backup, which is really not needed. Some of those things might be better, like I said earlier, kept in a bookkeeping file if considered necessary, but the compilation file should really stick to the year-end balances. That's the point here. There are certain procedures that we like to get done in a working paper file. And while we're not required to perform any procedures, the items I'm going to list come from the old days where most files and the old notice to reader engagements were done by hand. So yeah, I've been doing this for a long time, and some of us out there may have as well. But these are some things that might be useful to do in a compilation engagement file, which isn't really a procedure, but as part of that, assisting the client. So things like adding totals if they're manually prepared, or cross-footing item column totals when they're manually prepared. So when you have continuity schedules, that's one thing you might want to check. And even those Excel ones, if the programs are wrong, the footings could be wrong. So that might be something you want to check. Agreeing numbers to the backup and to the trial balance. So for example, a loan statement or a bank reconciliation or a trial balance, just agreeing those numbers back and forth to the trial balance. Ensuring that documents are in the client name. This is important in cases where there are multiple related parties or intermingling of personal and business funds. So if we've got a loan statement in the shareholder's name, we need to check about that and decide whether that belongs in the file or not. But other than that, there really are no additional procedures that would be required. I would mention, however, though, that some practitioners might decide to perform additional procedures in certain cases. And these are normally focused on what I would call risk areas, or areas that generally require follow-up subsequent to the completion of the file. Examples might include things like a quick reasonability calculation on GST or other compliance type returns that have been filed by the client as a means of preventing future issues with external overseers. So we know CRA is looking at our stuff. So, if you do a quick calculation on GST to make sure that the filings make sense, you might be able to prevent your client from going through an audit or something if it's done correctly, and having that comfort of knowing that it is done correctly. It makes you sleep better at night. So things like that you might want to do. But those are the types of things that you might want to do. But those are optional and risk-based types of things as opposed to being required. So something to think about there. So what other things might we expect to see in a compilation file? Here's a few items that in general practice have been included over the years, and these are considered to be quite common. So one thing we talk about is an audit waiver. And this document shows that the company is keeping up with the requirements under the Business Corporations Act. And practitioners often like to obtain a copy or have one for their file purposes, have one prepared so that if anything comes up, we have that document on hand or is available. Looking for evidence of an annual return. This documentation shows that the company is up to date on its annual filings and is officially active. The return, if it's available, is nice to have, but generally it's easier to look in a legal file and see if the lawyer has invoiced it. The consequences of not filing could result in the client's entity being struck, which can create problems with tax and other related filings. So if this is something that you can help the client prevent, it makes everything more efficient on all sides. T2 returns are common as these engagements are often included with the compilation engagements. Some firms even include T2 checklists in their compilation files to ensure constant or consistent application of the process. And I have noticed that practice reviewers like to see those T2 checklists in the file if you're doing those returns. So that's something you might want to think about. And then other T slips and returns, such as T4s or T5s, GST returns are often included in the file. Sometimes preparation of those documents are included as part of the engagement, and sometimes having evidence of proper filings assists with things like tax planning for the business client. And one thing we didn't talk about yet was sign-offs. When working papers are completed, looked at in the file, the working paper should be signed off by the preparer with the date that the document was prepared. Some of these working papers may have been provided or prepared by the client, which should also be indicated on that working paper. And this is usually as marking PBC on the document. And then same thing with the reviewer when it's reviewed, that sign off needs to occur. So this is the performance section, which you can see is much shorter and less busier than the acceptance section. So we're going to let you answer the quiz on performance here and see how you make out. A few more seconds here. Okay, how do we make out here? So in question one, the question was, it is best to include copies of all supporting documents in a compilation working paper file. The options were yes, that way there's no chance of error. Yes, more is better. Or no, backup for significant balances is sufficient. Or no, too much backup is inefficient and may confuse the nature of the engagement. So where we were leaning towards is those last two options. We don't want all that paper in the file. So yes, that way is no chance of error. That's a personal choice, I guess. But like I said, if you're going to have all that paper somewhere, keep it in a separate file and away from the compilation engagement. Make your I like to say lean and mean. Keep it efficient and keep it to what you need to have in there. We don't need to have 12 months of anything. We don't need all those copies of invoices and stuff. If you want that for bookkeeping purposes, I recommend putting it in the bookkeeping file. And more is better, more is not better, more is inefficient. So uses up computer space and shelf space and time for review and everything else. So those two options were not what we were looking for. Backup for significant balances is sufficient. We do recommend that. And the other answer is also acceptable. Too much backup is inefficient and may confuse the nature of the engagement. If you're doing bookkeeping or write-up, keep that separate from the compilation. We don't want to confuse the engagement. So we seem to be split on our decision there, but hopefully with a bit of explanation, that makes more sense. In the next question, what is the best form of backup to support the accounts receivable balance in a compilation engagement? The options were a detailed general ledger listing, an age trial balance, or copies of all the invoices. So again here, we only want that age trial balance. That's where we're going. We do not need a detailed general ledger listing in a compilation engagement. It just clutters the file. Get the age trial balance in there. Make sure it agrees with your final balance. That's all you need to have. We also do not need to have copies of all those invoices. If you want to look at them for whatever reason, you could put a tick mark to show that you saw them, but we don't need to see them in the file. But again, it looks like some of us might be a little bit confused, but the GL listing is not what we're looking for with respect to the compilation engagement. It may be how you got the numbers into the file, but as support for your receivables, we're probably just looking for that age trial balance. So hopefully there's no confusion there. In the third question, what would be considered to be acceptable procedures in the conduct of a compilation engagement? And the options were agreeing the numbers from the trial balance to the financial statements and the backup, checking to see that significant accounts such as bank accounts are in the client name, verifying accounts payable balances, cross-footing columns on a spreadsheet, or adding a list provided by the client. So there's one that does not belong here, and that is verifying accounts payable balances. We don't verify anything in a compilation engagement, so be careful. The only procedures we're doing is footing, cross-footing, and agreeing numbers for the most part. Verification, you're going into assurance there. So please be very careful. And I see that we almost all went with that option, and that's not a compilation procedure. Verification is really not done in a compilation engagement. So just please make sure you're aware of that and cognizant of that, because then you're taking the compilation into a different scope. And then finally, the last question here, the compilation standard requires that the practitioner, and the options were perform procedures on balances to ensure that the balances are correct, assist the client in preparing the financial statements, which includes a note which describes the basis of accounting, or ensuring that the financial statements agree with the underlying records. So the requirement is that we assist the client in preparing the financial statements, which includes a note which describes the basis of accounting. That's the answer that we were actually looking for. And the final one, ensuring the financial statements agreeing with the underlying records, could be acceptable as not an incorrect answer, but the one we were leaning towards was assisting the client in preparing the financial statements, which includes a note which describes the basis of accounting. So I noticed we were a little bit perhaps not in agreement in that section, but I hope nobody is being misled or misunderstands what we're trying to accomplish here. And again, I'll be doing questions at the end. So if there's any questions in that area, don't be afraid to ask as we get there. All right, now we're going to move on to completion. And now that the working papers are complete, the financial statement should be prepared and the file should be ready for review and the completion process. When the file is considered ready for review, we do suggest a two-step process or a two-step review process. So the first part of the process is what we call the senior's review. And we have to keep in mind that with a sole practitioner, the senior and the practitioner or the partner review is done by the same person. But for a bigger firm, the review process normally involves two people, usually a senior or a manager, and then the partner. So if we look at the review in two steps, then that's what I do recommend. So for this first review, we have a checklist, and this one covers 5 main areas. The first question asks whether the knowledge of the client is sufficiently documented. So this should be looked at from the point of view of an outsider looking in to determine whether the information in the file makes sense, is complete enough that you would be able to re-perform the engagement and to come out with a similar result. It is also a good opportunity to ensure that any updates to the client information and knowledge are made for any additional information that we obtained during the engagement process. So if we discovered something along the way, let's go back and update that knowledge document so that the next person looking at it has that information. Then we ask if the engagement acceptance procedures have been sufficiently documented, including having a signed engagement letter on file. Here, the reviewer is going to go through the acceptance process again and ensure that all of the required documents are on file and the requirements of the standard are still in place. Remember that the acceptance requirements need to be in place through the entirety of the engagement. And if anything has come up that you should or that should have caused you to decline the engagement had you known it at the time or at the beginning, then you do need to follow appropriate procedure. A big deficiency in compilation engagements is that signed engagement letters are often missing or are dated after the work was done. Attention to detail here is important, so make sure those engagement letters are in the file. If there is an impairment in independence, our checklist reminds you here to ensure that the impairment is properly disclosed, or if there are any threats, that safeguards are documented, in place, and still effective. The reviewer at this point is going to look at the financial statements and ensure that they are mathematically correct, the spelling and terminology are correct, that the numbers agree with the lead sheets and the underlying data. Mistakes often occur due to rushing the process or when changes happen outside of the normal process. When manual systems are in place, sometimes adjusting entries don't get properly updated to the lead sheets or to the working papers. So it is an important step to ensuring that everything ties in. And then the draft report needs to be checked to ensure that it's properly worded and dated and customized to the entity. We do find that reports tend to have a lot of errors in them if they're not looked at properly. So that's an important one. If applicable, tax returns should be reviewed for completeness and for correctness. And this is the first part of the review process. And any noted issues or queries should be addressed before the partner's review or the final review. If a practitioner is doing his own files or her own files, you would probably do this when you finish the file, and then you're going to wait a day and have another look at the file from an independent point of view. The second review does repeat some of the procedures outlined in our first review. In this excerpt, question 1 asks that the working paper file be checked for completeness, adequate documentation, sign-offs, indexing, and cross-referencing. So this is, again, a pretty important step, especially for those sole practitioners with no staff, because they are the preparer, the reviewer, and the partner, and those sign-offs need to be properly evidenced for at least the preparation and the review. So I will say that practice review looks for the fact that you did prepare it and then you again later reviewed it. When you're seeing that preparation and the review on the same day, that's a warning that perhaps you're not taking the proper amount of time to do those two steps. So be careful with that and make sure that you do give yourself some time in between those reviews. Sign-offs in the circumstance between the preparation and the review, if you're a sole practitioner, again, should be on different days to show that you did have that sufficient time to review it from a clear perspective. And this is a way as a practitioner addresses the self-review threat. When the practitioner is doing his own files, you have a self-review threat. So you have to recognize that in your acceptance. And then having that separate day in between is how you reduce that threat. So something to think about there. Cross-referencing in a file tends to be either very good or very bad, as we've noticed. Proper utilization can be very efficient, can save you time and duplication of effort. It also helps to keep your file organized and easy to follow. So we don't want to look for numbers or information in the file. We need to know exactly where we're going to go. It should be easy to find at all times. The next step is to look at the report again and ensure that it is in compliance with the standard and that any impairment of independence has been disclosed if it's applicable. Our checklist then asks the practitioner to ensure that any queries have been appropriately answered and working papers updated where necessary. And that would be both with the client and within the engagement team. This is really important because it's assumed that a query sheet could be removed from the file with no negative effect to the information available in the file. I do work with a lot of practitioners in reviewing files, and quite often I'll make a query on a query sheet and the answer comes back on the query sheet, but they don't update the file. Well, what you need to do is update the file. If it's on the sheet, that means it needs to be updated in the file. And you might want to have a system in your office that shows how your queries have been properly cleared. And when you're dealing with more manual systems, a simple question and answer column, and I know Caseware has the issues or other things with them as well. So there's different ways of doing it, but make sure you have some sort of a system. Question 4 addresses the requirement to do a stand back and to read the financial statements. So the main purpose of this step is to look at the financial statement from the point of view of an outsider looking in and to see if there is anything that might cause the financial statements to appear misleading. If something looks unusual, then you as a practitioner are required to discuss the matter with your client, ask for more information where necessary, and find out if anything else needs to be done. And on top of that, I just want to remind you to make sure that the basis of accounting agrees and works with the financial statements, or update it and get the client to sign off on that update. Because again, the point is to make sure the financial statements agrees with the basis of accounting. While the report indicates that compliance with the standard, the practitioner does need to remember that he or she cannot say that they've complied with the standard unless all of those requirements of the standard have been met. So again, that's an important part. And it's a great time to have another look and check the format of the financial statements. Check that spelling, oh my gosh, and the grammar, ensuring that the information agrees with the underlying data and appears to be correct. And even though the financial statements do belong to the client, the practitioner is most often the one that's preparing that final version. So it makes sense to make sure that they look as professional as possible. Your product is your report, but if you're attaching a report to something that doesn't look professional, it does have an impact on how people regard you. So make sure that other stuff looks good and is correct. And then before the release of the financial statements and the compilation engagement report, management must acknowledge and accept responsibility for the final version of the financial statement. And this also normally covers the adjusting entries made on their behalf as well. This is normally documented in the form of an acknowledgement letter, which is similar to a representation letter in some cases. Keeping in mind that this is a compilation engagement, and the representation letter, if you're using that format, keep it simple and get rid of all that review stuff that doesn't belong in the letter. So the actual acknowledgement basically would cover just the stuff that they agreed to at the beginning of the engagement and the fact that they accept the responsibility for the adjusting entries and the financial statements. For the file, you will want to document when you receive management's acceptance of responsibility. If it was verbal, this date is important because it needs to be documented and followed up with something in writing. So you might have sent the client a draft and had a conversation, and the client would have said, "Yeah, we're good to go. Get them ready. Get them ready. I'll pick them up." Make sure you document that conversation, and then you will follow it up with something in writing, which would be something like that acknowledgement letter that we talked about, or the short form representation letter. And then question 5 reminds you that management needs to review and approve the financial statement and any adjustments made on their behalf. So the final copy, which was approved by management, that final copy of the financial statement needs to be in your file. And we do recommend that you mark it as such so that there's no confusion. And we do have practitioners who keep their signed documents in a different place than their final documents in a different place than from their file. But with paperless files being so common now, and you're going to need it for practice review anyway, why not just get it in the file? Get those signed documents in the file so that the file is complete within itself. Or at least document where you're going to find those other documents, because what happens is when I'm reviewing files, I get the file from the practitioner, and then I have no signed documents or no final copies, and I can only review what I see, and basically the file is incomplete as it's been submitted. So make sure you cover that off if you can. I make the recommendation that it all be in the file. And that just makes sure that there's no confusion as you go, but especially that final copy of the financial statements, because the one that comes up on Jazzit or whatever program you're using on Caseware or other program, it may be a draft, it may be incomplete, it might have changed, we don't know. So we need to make sure that that final copy is in the file. So that is the completion process. So here's some common errors that we're finding in the financial statements and the report, and hopefully this will help you with respect to what to look for when you're doing those. Unfortunately, we're still seeing unaudited see notice to reader on the title page or at the top section of the statements. We're seeing people referring to the compilation report on the financial statements. Please don't do that, because there should be no association. Don't forget that because we have a note now, we should have a reference to the notes on each page of the statements. Normally that would be a footer at the bottom of the statements saying, please refer to attached notes to the financial statements, or something similar to that. And we are getting logos on the financial statements, and I've seen a little bit of an upsurge in those, but hopefully if you're doing that now, you'll know to get those off right away. We need to get rid of those. We have problems with addressees in the report, or a lack of addressees in the report. Don't forget that the report should be addressed to somebody, so the shareholders or management or the members of, so don't forget to include that part. And financial statement references, we do have to name the correct financial statements in the report, and I've seen a lot of different variations and errors. But, if it's a corporate entity, we're going to use terms like balance sheet and income statement. If we're using not for profit, if it's not for profit, we might be using different names like a statement of financial position, etc. But make sure that the statement name is the same as what's in your report, because your report is basically your index. If it's not attached to the financial statements, then somebody will know that it's missing. So that's basically what your report covers. And we want to make sure the correct names are there as well. People are forgetting to reference the basis of accounting note. So that is a requirement. It must be in the report. So let's get it in there and make sure it's the correct note number as well. So if you've got more than one note, we refer to note one because that's typically what the standard expects to see. But if you have, let's say, 3 or 4 notes and the basis of accounting is actually note 2, then make sure we're referring to note 2. That's an important one to keep in mind because everything should tie and link properly. Dating issues. Don't forget that the report cannot be dated till on or after the date that management accepts responsibility. So, you can't wait for them to pick up their records and have them sign it on that day. You got to get that acknowledgement letter signed, ideally before the report is completed and goes out the door. So dating issues are important. And then again, we mentioned the final approved copy not being in the file. Let's make sure we have those financial statements in the file. And your file is your evidence. So if it's required, I know we have it on hand somewhere else, but consider getting it into the file just so that you have everything where it needs to be. And there may be other things out there, but those are the ones I'm seeing most common and then I'm reporting on. And note that the completion report should be dated on or shortly after the date that you receive management's acceptance for the final version. That's just a common reminder because it's taking a while for practitioners to get that one right. And it is common to see them being dated after the fact because that's when management's picking it up, but that's not the way it's supposed to work. Okay. And then we've got a sample report on this slide, and we just want to make sure that you have the right report and you're in compliance with the standard. I've just seen a few practitioners out there with a different version or a muddled up version. So let's make sure that we have the report and that it's correct and all the proper features are in there. Note that if there was an independence issue, that there is a required disclosure, and that information would follow the last sentence of the report. And it's important to know that should facts or information come about after the issuance of the compilation report that cause the information in the statements to be misleading, then the practitioner is required to perform certain procedures. So this is something that might not have existed in the prior standard, but this includes things like discussing the issue with management, determining whether an amendment would be required, and inquiring as to how management will address that issue if an amendment is required. If there is an amendment, you do need to provide a new report, and the financial statements will have a note with the nature of the amendment, and the report will refer to that note. And then your job is to advise management, to inform users, and to provide users with the updated financial statement, which is different from the assurance standards, which ask you to ensure that other users get them. You're just supposed to advise management in this case. And then if they refuse to amend the statements, you have to take appropriate action. And that may not be covered in the standard, but in that case, we refer you back to the association rules, because if the report is incorrect and that association leaves you with misleading information, you may have to go back to the association rules for guidance. So that's the best source I can remind you of there. And okay, I think we have one more quiz here for you. So let's have a look at that and see how we do. I'll give you a minute or two to look at those. Okay, let's have a look and see how we made out on this one. So in question number 1, the purpose of reading the financial statements under the compilation standard is to ensure that, and the options were, there are no spelling errors, the financial statements do not appear to be misleading, or that the financial statements are mathematically correct. And we all agreed on the correct answer, or the preferred answer here, which would be that the financial statements do not appear to be misleading. In the second one, proper sign-off on working papers by the preparer and the reviewer are important because, and the options are, it demonstrates supervision of less experienced staff. It demonstrates that the sole practitioner with no staff allowed sufficient time between the file preparation and the review. And it demonstrates that procedures required under the firm's quality management system have been followed. And all 3 of those were good answers or correct answers, and you guys agreed with me on that, so that's good to see. Then our final question here was, what is the best time to have management sign an acknowledgement that they accept responsibility for the final version of the financial statements? And the options were when they come to pick up their stuff and pay the bill, or when they drop off their records for file preparation, or when they have reviewed the final draft before you have your compilation engagement report. So the correct answer is the third one. They need to accept responsibility when they have reviewed the final draft before you've attached your report. So for those who believe that it should be when they pick up their stuff and pay the bill, you're offside already. This is evidence, and evidence of the file has to be complete before the file can be released. So ideally, you're going to have them sign off on that at the time you issue the report. When they're picking up your stuff, you've already signed the report. So it doesn't make sense that you would do that unless you're darn sure that they are that they are picking it up on the same date. And that would be the issue there. But we don't want to mislead anybody here. It has to be when they've reviewed the final draft and before your compilation engagement report gets issued. So hopefully everybody's okay on that front and that everything's good and we all understand that. And then we are at our conclusion. So what I can do now is we can answer questions, or I can answer questions if you have any on any of the content in the engagement or any related content within the engagement, if that's helpful for you. So I am happy to hang around and answer any questions that you have. And while you're thinking about those, you can use the chat or the question and answer feature. And while you're thinking about that, just a reminder that we have recorded this webinar. So if you did have to miss any part of the webinar, I will be downloading it and then re-upping it to the website once we're done. If it's not there, give me 24 hours. Normally it can come much quicker, but give me that, and that way if we've had a problem at all, it gives us time to get it there. To access that video recording, you will need to log back into the Ash Grove Learning website under your account, and you're going to look for this event, the Compilation Engagement for Practitioners event. And when you access that, you will see the recording there. That is also where you're going to find your certificates for PD. So please don't forget to do that as well. And yeah, if you enjoyed this webinar and if you think that you have any colleagues or friends that could benefit from it, please let them know about us. And we've just uploaded this course to the website as well. So it's available as future webinars or as a course at any time as a course. And we would be happy to have them do that if they have any questions. We also have those other courses available as well, and several others. So please, if you liked it, please let them know. If there's any problems, please let me know. So if I can help you in any way, I'd be happy to assist. That is what I do. I assist practitioners, and it's my goal, and I enjoy what I do, is helping people do it right and get them passing their practice reviews and being efficient and making money at this process. So that's what I hope for you guys. So I can wait here for a little bit longer. I'll probably mumble away until I I see or don't see anything from you. I'll give you another minute. And our contact information, if that doesn't work for you, is on the screen in front of you. Please don't be afraid to contact me directly. My email's there, my phone number's there, the website is there, um, and we hope that those resources will be useful to you as well. So I'll give you a few more seconds, and I'm not seeing any questions. Hopefully that means I did a good job. And if not, then hopefully you will ask me after the fact and I can help you that way. Okay. And seeing nothing, we are going to say goodbye then. Oh, maybe I do have a question. Hang on, I might have missed something. Um, what are some examples for where you have more than one note? Um, I know a lot of practitioners like to put in the property and equipment schedule and the share capital. Those would be the typical notes that you might see in a compilation engagement. Depending on the nature of the entity, you might include a couple other ones. I just caution you that um, don't get too notey or too wordy with a lot of notes and policies and stuff, because that confuses the nature of the engagement. But normally you might see the odd schedule, such as the share schedule or the capital asset schedule. And that would probably be the best examples I could offer. Okay, I don't think I've missed any now. Just check all my screens here and it looks like we're good. All right. So anyway, thanks again, guys. Thanks for attending and being part of the webinar. We appreciate you, and please let us know if there's anything we can do to help you, and we'll catch you next time. Bye for now.